Welcome to the Trading Psychology, a channel dedicated to sharpening your trading mindset and helping you navigate the market with confidence. Today, we're diving into a story that feels almost unbelievable. Imagine a trader from over a century ago, long before computers, algorithms, and instant news feeds, yet the rules he lived and traded by are still being whispered about in trading rooms around the world. That trader was Jesse Livermore, famously known as the Great Bear of Wall Street. What made him legendary wasn't luck or intuition alone, it was a set of principles so timeless, so precise, that even today, traders who follow them often outperform the crowd. Some call his methods mysterious, almost like a secret code that only disciplined traders can unlock. Why do his trading rules still crush the market today, when everything else has changed? That's what we're about to uncover. In this video, we'll break down 5 of Livermore's most powerful rules, exploring not just what they are, but how you can apply them in today's markets. Step by step, we'll connect the dots between his century-old strategies and modern trading realities, revealing the mindset that separates winners from the rest. And at the very end, we've prepared a simple, actionable exercise for you, a practical homework that puts these rules into your hands immediately. So, make sure you like this video, subscribe to the Trading Psychology, and share it with friends who are as hungry for trading success as you are. There's a lot more insights coming your way, and you won't want to miss them. Chapter 1: The Importance of Trend Markets. Don't wait for anyone. You can try to guess, you can hope, but if you fight the tide, you will get swept away. Jesse Livermore knew this better than anyone. The legendary Great Bear of Wall Street built his fortune not on luck, but on the simple principle of following the trend. He famously said, "The market is never wrong. Opinions often are." Every successful move he made was aligned with the market's direction, never against it. Modern research backs this up. Behavioral finance studies show that most traders lose money because they resist trends, holding positions against the market out of pride or impatience. Trend-following strategies consistently outperform strategies that try to predict reversals. From stocks to crypto, the principle remains unchanged. Momentum favors those who move with it, not against it. Think about it practically. If the S&P 500 is clearly in an upward channel, fighting that momentum with short positions is a recipe for frustration. Similarly, in crypto, a bullish breakout doesn't care about your predictions. It rewards participants who enter at the right moment and ride the wave. The trend is a silent instructor, it doesn't negotiate. Those who understand and respect it can compound gains steadily, while others chase losses trying to force outcomes. Here's the takeaway: before you place a trade, stop and ask yourself, what is the market telling me? Are prices rising or falling? With conviction, your first task isn't to prove you're right, it's to align yourself with what's already happening. Observe, measure, and then act. The moment you resist this simple logic, you invite unnecessary risk. A practical way to internalize this: start your next trading session by noting the dominant trend in your chosen market. Mark it visually on charts or write it down. Then, identify one opportunity where your action naturally follows the movement, rather than against it. Keep a short note of the outcome. Over time, this becomes less of a strategy exercise and more of a mindset shift. Your instincts begin to tune into the market's pulse instead of your own ego. Remember, the market doesn't reward cleverness, it rewards discipline. Align with the trend first, and the rest falls into place. Fighting it is futile, observing it is powerful. Chapter 2: Cut losses quickly. Every trader has felt it, the creeping dread of a position slowly bleeding money. Jesse Livermore knew this fear well, and he built a career on one uncompromising rule: never let a small loss become a big one. He said, "It is not good to be too curious about the market. It is better to move quickly when wrong." His genius wasn't in predicting perfection, it was in stopping mistakes before they snowballed. Modern research reinforces his approach. Studies in behavioral finance show that holding on to losing positions is one of the primary reasons traders underperform. Loss aversion, pride, and the hope that it will come back are powerful psychological traps. Stop loss strategies, position sizing, and risk management tools widely used today are the descendants of Livermore's original philosophy. Limit the downside, let the upside breathe. Think about how this works in practice. If a stock starts falling after your entry, waiting for a rebound can turn a minor setback into a portfolio drag. In crypto, sudden volatility can wipe out weeks of gains in minutes. The lesson is clear: cutting losses early isn't failure, it's self-preservation. Livermore viewed it as a discipline, not a concession. Every small loss avoided is capital preserved for the next opportunity. Here's a way to integrate this idea naturally. Before opening a trade, identify the point where your thesis is invalidated. Write it down, mark it on the chart, and commit to exiting if that level is reached. Think of it less as a rigid rule and more as giving yourself the freedom to act decisively. Observing your exit criteria builds confidence and removes emotional hesitation. Remember, the market punishes hesitation and rewards decisiveness. Protecting your capital is not optional. It is the foundation of any lasting success. Every trade that is cut at the right time is a step closer to building an account that can survive storms, seize opportunities, and ultimately thrive. Hesitation is expensive. Acting too late is fatal. Discipline, clarity, and respect for your limits transform losses from disasters into manageable lessons. Cut early, stay alive, and let your winners run. The moment you cling to a losing position, you hand power to the market. Livermore's wisdom is as brutal as it is beautiful. The market doesn't reward sentiment, pride, or stubbornness. It rewards those who act before regrets take hold. Chapter 3. Let profits run. Every trader knows the thrill of a winning position the instant when a trade turns green and your account feels alive. Yet Jesse Livermore warned against the greatest enemy of profits, impatience. He understood that selling too early is often more dangerous than holding too long. Livermore said, "The big money is not in the buying or selling, but in the waiting." His wealth was built by letting the market reward him, not by constantly jumping in and out. Modern research confirms his insight. Behavioral finance studies highlight that traders often underperform because they close winning trades prematurely, driven by fear or the urge to lock in gains. Conversely, strategies that ride trends and let profits accumulate over time consistently outperform reactive trading. From equities to commodities to crypto, the principle holds: the market favors those who exercise patience, not those who act on impulse. Think about this practically. Imagine a stock breaking out on strong volume. A trader who exits at the first sign of hesitation misses the main move. In contrast, a trader who monitors key support levels and allows the position to grow with the trend captures a much larger portion of the move. Even small incremental gains compound into substantial profits if you resist the urge to prematurely cash out. The lesson is simple: discipline and timing, not emotion, determine your edge. Here's a way to embed this mindset naturally. When you enter a trade that aligns with your analysis, mark key levels on the chart that indicate where the trade would become invalid. Then step back and allow the market to work for you. Observe how it unfolds without micromanaging each tick. Keep a note of the trade's progression and how your patience affects the outcome. Over time, this becomes an instinct rather than a checklist. It trains you to recognize when a winner is truly running. Remember, the market does not reward anxiety or quick fixes. It rewards patience, clarity, and strategic restraint. Cutting winners short out of fear is a silent drain on your account. Every time you allow a profitable trade to unfold fully, you honor the discipline that separates consistent traders from the rest. Let profits run, but do so intelligently. The moment you yield to impatience, you surrender potential. Livermore's wisdom is ruthless but illuminating. Wealth grows when patience governs action, not panic. Chapter 4. Timing is everything. The market doesn't rush, but it certainly doesn't wait. Jesse Livermore built his fortune on one unforgiving truth: entering a trade at the wrong time is as dangerous as choosing the wrong direction. He warned, the desire for action is the enemy of good trading. In other words, impatience destroys capital faster than bad analysis ever could. Livermore's edge wasn't in predicting every move, it was in knowing exactly when to act. Modern trading psychology and behavioral finance research confirm his insight. Traders who force entries or chase setups often suffer from confirmation bias and overconfidence, resulting in repeated losses. Conversely, disciplined traders who wait for the right conditions, using price patterns, volume signals, or key support and resistance levels, significantly improve their success rates. Timing is not about luck, it is a skill honed through observation, analysis, and restraint. Think about this practically. Imagine a stock consolidating in a tight range with increasing volume. Jumping in prematurely may result in a whipsaw and a loss. Waiting for the breakout or a confirmed retest aligns your entry with momentum, increasing the probability of success. In crypto markets, where volatility is extreme, acting before a setup confirms often leads to unnecessary drawdowns. Patience here is not passivity, it is strategic positioning. A simple way to develop this instinct: before initiating a trade, define the conditions that must exist for you to enter. Track these criteria on your charts and observe the market patiently. Note when setups mature and how acting on them versus acting early changes outcomes. Over time, this becomes second nature. You begin to sense the rhythm of the market rather than forcing it to fit your schedule. Remember, the market rewards discipline, not haste. Every impulsive entry chips away at your edge, while every well-timed action compounds your advantage. Livermore's lesson is clear: waiting is not weakness, it is power. Success belongs to those who act with precision, not to those who act on impulse. Time your trades, respect the signals, and let the market's rhythm guide your decisions. Hesitation may seem costly in the moment, but impulsiveness is far more expensive in the long run. Chapter 5: Money and Psychology. Management trading is as much a battle inside your mind as it is on the markets. Jesse Livermore understood this better than most. He repeatedly emphasized that controlling emotions and managing the size of your positions were far more important than any clever strategy. It is not the thinking that counts, but the discipline to act consistently. He once said, without emotional control, even the best analysis can unravel in seconds. Without proper risk management, a single mistake can wipe out months of gains. Modern research in behavioral finance backs this up. Studies show that over-leveraging and impulsive trading are leading causes of account blowouts. Traders who maintain clear rules for position sizing, stop losses, and journaling their decisions consistently outperform those who rely solely on intuition or gut feelings. Psychology and money management are inseparable. Understanding one without mastering the other is a recipe for repeated losses. Consider this practically. A trader entering a high-volatility stock with excessive leverage can see a small adverse move turn into a catastrophic loss. Conversely, by sizing positions appropriately and monitoring emotional responses, fear, greed, or overconfidence, the trader can stay in control, learn from each trade, and protect capital for future opportunities. Journaling trades, noting both actions and feelings, turns subjective emotions into objective data to guide better decisions over time. A practical approach to internalize this: before every trading session, define maximum risk per position, set clear mental limits, and pause to check your emotional state. Ask yourself, am I reacting to the market or to my own fear? Track these notes over time to see patterns emerge. Over time, managing your money and your mind becomes second nature. Trading is no longer a roller coaster, but a disciplined process where logic and psychology align. Remember, the market punishes arrogance and impulsiveness but rewards measured, deliberate action. Leverage is seductive, emotions are persuasive, but mastery over both is the foundation of lasting success. Your mind is your greatest asset, and the way you manage your capital and your psychology determines whether you survive, thrive, or fail. Discipline isn't optional. It is the difference between consistent profits and repeated ruin. Respect your limits, protect your capital, and never let emotion dictate your choices. Livermore's wisdom is blunt and uncompromising. The trader who masters psychology and money simultaneously masters the market. Summary and action: trading is simple in theory but brutally demanding in practice. Jesse Livermore's 5 timeless rules provide a framework that remains just as relevant today as it was a century ago. First, follow the trend. Align yourself with the market's direction rather than fighting it. Second, cut losses quickly. Never allow a minor mistake to escalate into a disaster. Third, let profits run. Patience is the silent engine of wealth, and selling winners too early is a common trap. Fourth, time your trades. Enter only when conditions are favorable, because haste is far more costly than waiting. Fifth, manage your money and psychology. Discipline, position sizing, and emotional control form the bedrock of lasting trading success. Together, these rules create a resilient mindset that separates consistently profitable traders from the rest. The brilliance of Livermore's wisdom lies in its simplicity. It's not about predicting every market move or relying on luck. It's about developing habits that consistently tilt the odds in your favor. Behavioral finance confirms that most losses stem not from lack of knowledge, but from failing to respect these fundamental principles. By internalizing these rules, traders equip themselves to respond rationally under pressure, preserve capital, and seize opportunities with clarity. Every trade becomes a controlled experiment, every outcome a lesson, and every session a step toward mastery. To turn this understanding into actionable skill, here are 3 practical steps for you to integrate into your daily trading routine. 1. Trend scan. Before you place any trade, observe your chosen market and identify the prevailing trend. Determine whether the momentum is upward, downward, or neutral, and let this guide your decisions. 2. Entry and risk setup. Define your entry point and stop loss based on Livermore's rules. Ensure your risk is limited, your position size is appropriate, and you're not letting emotion dictate timing. 3. Trade reflection. After the market closes, review your trades. Ask yourself, did I follow the trend? Did I cut losses early? Did I let profits run? Take notes and refine your approach. For the next session, apply these steps consistently. Point your discipline in the right direction, and the market will reward clarity over impulsiveness. Prepare your mind and your plan before you trade. Like, subscribe, and share the trading psychology with friends who are equally hungry for trading success. There are more videos to help you sharpen your skills, build discipline, and step closer to mastering the market. Every share spreads knowledge, and every session reinforces your edge.